Good day, everybody. My name's Eric Berman. I'm a partner with Eide Bailey. Welcome to our November webinar, even though it feels like September. So for this webinar, we're not talking about GASB standards. We're giving you a break from GASB standards this webinar, although we're going to resurrect them coming up in December. So those of you who are going to go through GASB withdrawal, it's okay. You'll see some other stuff coming up at our year-end presentation coming up in a few short weeks. So today we're talking about subrecipients and beneficiaries and why the difference matters. There are tons of instances in federal grant operations where it is really difficult to determine who or what entity is a subrecipient or a beneficiary. Now, some governments out there, mainly states, they've issued checklists on determining who is a subrecipient and who is a beneficiary, or even who is a contract and a contractor. Now, those of us who have work done on our houses may understand that last piece on contracts or contractors, but you'd be surprised, especially in the world of federal grant operations. The definitions we're going to go through in a little short time, they were modernized about a decade ago with the release of the Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards. Now, we all know this as the Uniform Guidance. Now, since then, we've had a bunch of federal acts and regulations that have tweaked the definitions and requirements, including most recently, as you all know, the American Rescue Plan Act from 2021. And we're going to spend a bunch of time in the American Rescue Plan Act and talk about some ideas in dealing with subrecipients and so on. But even so, this year, the nearly 2,000-page White House Office of Management and Budget Compliance Supplement, it contains nearly 270 provisions that may impact the decision of whether a payee is a subrecipient or a beneficiary. And then not just the decision, but what do you do once you make the decision? You got potentially 270 opportunities to have some audit procedures done. And again, those procedures are going to differ whether the payee is a subrecipient or a beneficiary. And those procedures also have to do with the Coronavirus Relief Fund. And so for those of you who are dealing with the CRF and so on, this is an important session for you today. And I welcome you. So today is an important session. And again, due to this importance, joining me is Kurt Schlicker, a partner from our Reno office. And I'd be remiss if I didn't mention that he's one of the leaders probably in the entire nation on the understanding of the federal single audit and the provisions of the uniform guidance. So Kurt, why don't you feel free to embellish, and then why don't you take a walk through the agenda with us?
Sure, thank you, Eric. Well, I probably won't embellish as much as Eric would. Thank you for that introduction. As Eric said, my name is Kurt Schlicker. I'm a partner in the Reno office. I probably focus, 95% of my year on auditing governments, generally larger governments, state, counties, larger cities. I've audited grants from probably every major U.S. federal agency, whether it's labor, health and human services, higher ed, healthcare, et cetera. So I do a lot of different single audit and consult with a lot of different single audit projects. So hopefully we can pull from some examples that we've seen across the country and have some good discussion today. Please, as you all have questions, we have plenty of time. We left some time in the presentation to go over questions. It's not like Eric or I are gonna be chatterboxes nonstop, going a million miles an hour to make it to the end time. We have plenty of room for questions. We anticipated a lot of different questions, a lot of different scenarios. So if you have scenarios and you wanna run them by us and get some thoughts, please chat them in and we'll go through them. As far as what we're going to cover today, we're going to start with the groundwork on definitions of key terms. And it's pretty important to understand where federal regulation define certain terms and where we started, and then kind of the shift in thinking through the CARES Act and ARPA, because prior to the CARES Act and prior to ARPA, some of this beneficiary concept items didn't really exist in the way they do today. And I've gotten a lot of questions on, why hasn't this ever come up before? Why 10 years ago weren't we talking about this? Why 5 years ago weren't we talking about this? Why is this such a big deal now and it hasn't been before? And we'll talk about the change and the morphing guidance as we go. Then we're going to go through kind of some example determinations, some case studies, different what if scenarios. We've got, I don't know, 5 or 6 in there of what if scenarios, but we left it very open to invite you all to also add in some what if scenarios. So like I said, as you have them, or if you have them, please feel free to chat them. Then we'll end with some quick reminders, which is mostly going to be on monitoring requirements. We'll talk about contractors a little bit. We'll talk about, some of the programs we've seen across the country, et cetera. And that will pretty much take us to the 2-hour mark, and we'll go from there. So again, invite you all to ask questions as we go. So starting with definitions and kind of setting the picture. And hopefully everybody knows by this point, uniform guidance, and I'll refer to it as uniform guidance throughout the presentation. But what we're really talking about is 2 CFR Part 200. If you haven't been there before, it's wonderful. Just Google 2 CFR 200. You'll get the electronic code of federal regulations. It'll be bifurcated into different subparts, and you can read at your leisure. So these definitions come from the uniform guidance, and you'll love the first definition. The feds were great there. Contractor means an entity that receives a contract. And it's been a while since I've been in school, but I remember when I was in school, my English teacher saying, never use the word in the actual definition, because that never makes sense. You kind of go around in a circle. And well, the feds obviously didn't follow that example, and so they tried to be clever. So then you go, what does a contract mean? And for the purpose of federal financial assistance, a contract is a legal instrument by which a recipient or subrecipient purchases property or services needed to carry out a project or program, et cetera. Now, what's the key words in that definition? Federal financial assistance and the purchase of property or services. Okay, so in a big picture, if we take a step back, contract means a legal instrument to purchase property or services. Okay, so let's remember that in the back of our minds.
Kurt, before you finish on that one, the way I kind of look at contracts and contractors is the other party. Do they have the ability to sell their services to anybody? So for example, Eide Bailey is a contractor. We can sell our services to you all on the webinar, assuming you're clients and non-clients, or as well as Eide Bailey staff, or, we can sell it to somebody else. And it really doesn't matter, because we're not bound except by the terms and conditions of the contract as a legal instrument. I mean, wouldn't you agree that it's similar to the folks putting a roof on a house? They can put a roof on your house and then sell it to somebody else.
Yeah. Real big picture without getting over complicated. And we'll cover some aspects at the end of the presentation. But I mean, really, to simplify it, a contract, that's where somebody's operating in a competitive environment. They're running a business. Okay. So if you think about that, you enter into a contract, you're entering to somebody that's running a business, providing a good or performing a service. All right. So now parsing that definition down a little bit more and focusing on a couple of the key words. Well, what does federal financial assistance mean? Because that was one of the key words. Well, federal financial assistance is kind of a catch-all, and federal financial assistance can mean grants. Okay, that's probably what most of you are familiar with. It can mean cooperative agreements. Those of you that don't know what a cooperative agreement is, that's just another form of an instrument where the feds are participating more in a project than they normally would in a grant, right? In a grant, you get your money and you run the program and you go with it. A cooperative agreement, as the name would suggest, has a little bit more agency by the feds, meaning they're cooperating. It's kind of a dual agreement, dual participation as they carry out the program. You can have surplus property. That's very popular, and for those of you that don't know, police departments, fire departments, Homeland Security, a lot of anything that's generally law enforcement related, they get a lot of surplus property from the military, right? As rifles are decommissioned from the military, a lot of police departments then can bring those into their armory. Direct appropriations, food commodities, that was a big one, obviously, with the pandemic, and especially with kiddos in schools, right? A lot of kids relied on school lunch. And then when schools closed, all of a sudden, what did we have on our hands there? How did we feed a lot of the families that were relying on those commodities? And then other financial assistance, which was what CRF was defined as: loans, loan guarantees, insurance, subsidies. Those are, the insurance and subsidies are a little bit less common. We usually see grants, cooperative agreements, other financial assistance, commodities. Those are more what we see. Federal financial assistance does not include amounts received as reimbursement to individuals under Medicare or Medicaid. And it's kind of funny, they parse out Medicare and Medicaid in the definitions. If you ask me why they don't include other major programs that are benefits to individuals, like unemployment insurance for one, I don't know. This is just what's been codified, where they scope out saying, hey, Medicare, Medicaid reimbursement services do not count to the individual.
Do you think it has something to do with the dollars? Other than during really bad periods of unemployment, including during the pandemic, the dollars on Medicare and Medicaid and the individual reimbursement volume must be so high. It certainly it was when I was in a state. It's just so high. Why bother?
Yeah, I mean, I would say if you look at states across the country, Medicaid's probably somewhere between 35 and 65% of their total federal expenditures.
Correct.
And so if you're looking at half your federal expenditures being Medicaid dollars, I guess they clarify that and figure out the aggregate can make up the difference. But anyway, that's federal financial assistance. That's what we're talking about today in the scope. So I'll talk a lot about pass-through entities and subrecipients. What does that mean if you're not familiar with the term? The pass-through entity, that in layman's terms is the entity that receives money and then gives it to another tier entity. So passes it downwards. So a state giving money to a local government, a county or a city giving money to a nonprofit. They can give it to each other. The counties can give it to other counties or cities or to housing authorities, right? So the pass-through entity is the entity that receives the money, and you can be both. You can be a county. You can receive money from the state and then take that money from the state and then pass it through to a local nonprofit or to a city or to the housing authority. And so you can be the subrecipient of the state and the pass-through entity to that housing authority or nonprofit. But that's That's the flow. So pass-through entity is the one giving money to a subrecipient. The subrecipient is the one receiving that money through a subaward from the pass-through entity to carry out part of the federal award. And here's the key: does not include an individual that is a beneficiary of such award. So what do we mean by that? Let's look at a couple of programs. Foster care. Everybody's relatively familiar with foster care, where kiddos that are, wards of the state or your local jurisdiction, that we pay a foster care subsidy, right? We pay a subsidy to the foster care families to help take care of those children that are wards of the state or county or local jurisdiction, depending on how it's arranged. And we pay a subsidy. Well, that foster care provider is a beneficiary, is an individual that's receiving kind of the end benefit of that federal program. That foster care family is not a subrecipient, right? They're not an entity that is receiving a subaward. They're receiving a subsidy. Another example, unemployment insurance. The participants on unemployment, you're not entering into a subaward with each participant in unemployment to receive that benefit, right? They're the end user of that benefit. Okay, so just like Medicaid, Medicare, we just talked about that. Now, what's the hole and where did the problems kind of start from? The definition in uniform guidance only says does not include an individual. They do not say anything about does not include an individual or entities that are a beneficiary of such award. They just focused on the individual piece. So historically, pre-pandemic, you've probably attended webinars or seen guidance where every dollar that went to an entity, whether it was to a local government, to a nonprofit, to a commercial entity, whatever, everything ran through this vendor or contractor versus subrecipient checklist, right? That was like the holy grail, was vendor versus subrecipient. And that's what we had to determine on every single contract, every single subaward, cooperative agreement, regardless of what we called the written agreement. We had to kind of determine, are they a subrecipient or are they a contractor? Okay, well, as you can imagine, what happened when the CARES Act was passed, and this was passed in March of 20, if those of you that don't remember, March 27th was kind of the CARES Act D-Day. And it created a lot of different programs, right? It created Coronavirus Relief Fund, the Education Stabilization Fund, Provider Relief Fund. It's for healthcare enhancements, keeping workers paid. But the big one in bold there, economic stabilization. They really wanted to focus on economic stabilization because everybody was shutting down. Everybody was going home. And I still remember phone calls that were getting calls from clients, and we're saying, hey, we have all this money. We need to spend it. We have at that time until December 30th of 20 to spend it all. It showed up in our bank account basically in April, and we've got all this money to spend in the next 7 months. People are scared. We've got to send it out. We've got to give programs out. We've got to give money out. But all our systems are set up to treat these entities as a vendor or as a subrecipient. What do you think they are? And I'm like, well, what do you mean? And they're like, well, we are giving money to small businesses or to nonprofits to help with them closing. Are they a subrecipient or are they a vendor? And I remember thinking to myself, well, that kind of puts us in a quandary. That doesn't make a lot of sense, because you're not really purchasing a good or service when you're, giving $100,000 to that local nonprofit because they couldn't do any fundraising. So you're not purchasing a good or service, but they're not really carrying out a federal program either. And so a lot of states said, well, what's the conservative answer? And it's like, well, the conservative answer is subrecipient monitoring. And that's what they initially elected, is just make everybody a subrecipient, because that requires the most monitoring. Eric, I think you wanted to chime in on something.
Yeah, I mean, if we all remember what was going on back then, it was pretty much chaos. I mean, certainly Kurt and I, both of us remember a call we got, maybe about a month or two into the pandemic, from a very large city, from somebody who said, "I'm brand new to grants. What's a grant?" And we had that stuff going on, and it wasn't just subrecipient versus vendor or contractor. It was, how best can we get the money out today? And it really was kind of chaos. And unfortunately, we're living with the remnants of that chaos even still to this day. I mean, don't you think, Kurt? Especially with unemployment.
Yeah, and we can talk some about the subrecipient monitoring requirements, and we'll talk about, what requirements are there on beneficiaries a little bit later. But yes, absolutely, we are still dealing with this. No matter what jurisdiction you live in, you probably have heard about small business assistance, nonprofit assistance, emergency rental assistance, rent relief, extra unemployment benefits, all of these type of programs that are hopefully running around in your brains and in your heads. And if, again, to paint the picture, at the very start, it was, well, if it's going to an entity, it's a subrecipient or a contractor. And everybody was remote. Everybody was working from home. Everybody was on, very weird hours, lots of fatigue, and it was pretty much chaos. Mm-hmm. So then, thankfully, Treasury recognized this chaos relatively quickly. What's relatively quickly? I want to say this came out in the summer, around the June or July timeframe, if I recall.
That's right.
And they said, what are the differences between a subrecipient and a beneficiary just under CRF? So this is just for the Coronavirus Relief Fund. They didn't scope in other programs. This was in the FAQ before it had been codified into the Federal Register. But they said, hey, can you let us know what the differences are between a subrecipient and beneficiary? And Treasury responded. And it's a huge long paragraph, and I parsed it out, but audit requirements apply to any non-federal entity that receive payments, in excess of $750,000 or more, meaning that's when you need a single audit. Non-federal entities are subrecipients. Okay, not telling us anything new. We knew that. However, subrecipients would not include individuals and organizations that are beneficiaries of any assistance programs. So all of a sudden, it was like the sun shining down on everybody, and all the chaos that we had from the previous couple of months of all these small business programs, all these nonprofit assistance programs, charter schools that were getting a lot of funding. What all of a sudden we said, hey, Treasury just scoped in organizations as a beneficiary, recognized that an organization could be a beneficiary. And that led everybody to start reevaluating all of those earlier determinations. Now, that caused some chaos because a lot of organizations already had agreements in place, already had documents in place telling the business that they were subject to single audit, that they had to have open books and records, that they'd be monitored, that they could have a clawback, that they'd have to arrange for an audit with a CPA firm. So they had all these agreements that truthfully could be thrown in the trash, or at least amended. But the problem was there were so many of them, and depending on where these programs were out in their life cycle, states especially just said, we're not going to go issue new awards to all of these businesses. That's too much. We've got bigger fish to fry. We've got to spend the money. And it has subsequently caused chaos. We've seen it a lot, the amount of for-profit entities saying that their state or their county, their city is requiring an audit. And they go, we don't know what's required. We have this agreement. There's this paragraph right here. It says we're required to be audited under uniform guidance. Can you do that for us? And then we go, can you reach back out to your pass-through entity? Can you double check that they're imposing this on you? They reach back out, and unfortunately the entity, it's a new person that wasn't there 3 years ago when the agreement was entered into. And they said, well, the agreement says you're required to have an audit, so yes, you have to have an audit. And so now we're doing a bunch of for-profit auditing of CRF funds or other similar type funds across the country. And it's really kind of stemmed from a little bit of this chaos. I don't know, Eric, if you've been seeing similar type items on the East Coast or not. I know we've been seeing it a lot on the West Coast.
Yeah, certainly there are pockets of this, but also not to muddy the waters a little bit, but even if you're below 750,000, there is sort of a little bit of an out, even though you might be a subrecipient. There's a little bit of an out in the fact that there's a specialized engagement that was agreed upon between the AICPA and the various powers that be. That is a little bit less of a dive, but still we're seeing a bunch of those as well. I mean, are you seeing those examination engagements as well out west, Kurt?
Yeah, we're seeing a lot of just everything under the sun. I'm seeing a lot of under 750,000 in the county or the state saying we still want this to be monitored and audited. I've seen some asking for AUPs over the funds. I've seen some asking for examinations over the funds. I've seen some that are saying, oh, thanks for bringing this to our attention. Never mind, not applicable to you. I've seen everything under the sun. And it really, those of you on the call and auditors on the call as well, you have to step back a little bit, have a little bit of perspective on what was happening in March, April, May, June of 2020, and how fast the guidance was changing and how quickly everybody had to make decisions at that point in time to spend the money. And we're still seeing kind of the chaos from that now. To kind of summarize the three considerations now, you can either have a contractor, which obviously complies with terms and conditions in Appendix 2. It falls under contract monitoring, still purchases of goods or services. You can have a subrecipient. If they are deemed a subrecipient, they must follow Subpart F, which is the audit requirements of uniform guidance. If they are a for-profit subrecipient, yes, you can have those too if the pass-through entity deems that. They are not subject to uniform guidance, but are subject to the audit requirements that the pass-through entity imposes on them. And that can be a wide range. It can be a program audit. It can be an AUP. It can be, hey, just submit some records to us. It can be anything in between. If they are a beneficiary, and we'll get into a lot of this at the end, they are exempt from the contract conditions. They are exempt from subrecipient monitoring and audit requirements, but they are subject to whatever the terms and conditions of that beneficiary program that the entity set up. So if jurisdiction said, hey, qualify for this money, you have to show a revenue loss of $50,000. You can't count these types of expenditures, or you had to be closed, or you had to not lay off people, or whatever that is. And by the way, we're going to come in and look at your expenditures subsequently to make sure you spent them on these type of things. They're subject to all of those agreements, but that's at the determination of the entity creating the beneficiary program.
Now, before we finish on that, there's an interesting question in the chat that asks, for beneficiary payments, can a payor government or a payor, can you charge a federally negotiated indirect rate to beneficiary payments, Kurt?
So that's where you're going to have to look at the specific program guidance and modified total direct costs, and whether or not payments to individuals generally can't be included in there. There is that. See, here's the problem with kind of the guidance, right? It says payments to individuals generally scoped out. Subawards, they're capped at $25,000 when you calculate that modified total direct cost. This concept of negotiated indirect rates on beneficiary payments to entities, not really pondered in the uniform guidance definition, because if we go back a few slides, entities as a beneficiary isn't addressed in the uniform guidance. It's an FAQ here in CRF. So in those instances, what I would say is you reach out to whoever your grant federal liaison is, if you're direct with the feds, or whoever your pass-through entity is, and walk through it together and get their permission in writing if you're allowed to charge the indirect rate on it. I would generally say that if it's beneficiary, like a big beneficiary assistance program, there's got to be some time and effort there from a payroll and from a project management standpoint. It makes sense to me to charge indirect cost rates on it, but it's not expressly considered in the guidance. I don't know, Eric, have you seen anything one way or the other, how entities have been treating that?
Not especially, but I think about it. For example, I spent the better part of this past weekend in Fort Myers, Florida. And of course, that was ground zero for Hurricane Ian. And there were FEMA setups everywhere. Every half mile or so, there was a FEMA tent taking applications. And so that's directly through FEMA, but some of it was handled through the state of Florida and through the county. And there's got to be some overhead. So it's got to be negotiated in that situation with FEMA to have some form of overhead and cost recovery of their costs that are in there, because it is obviously a disaster area. And I would tend to think that most beneficiary guidance will have that sort of provision, but I haven't seen it expressly mentioned. Certainly not in the uniform guidance.
Right. And so, and I'm thinking of, just some other situations like, let's take unemployment, for example, right? How claims skyrocketed, and you don't necessarily have, you're not charging on a modified total direct cost there to benefit payments going out, but each state has some sort of cost allocation plan or number, FTEs or some other indirect mechanism where they're charging payroll. And obviously time and effort went skyrocketing for unemployment. And so they would recapture costs through the cost allocation plan based on that skyrocketing time and effort and resources dedicated to it. Again, indirect costs are just kind of tricky. It just depends from program to program to program, and whether it's modified total direct and a rate or cost allocation and different caps by federal statute, et cetera.
We certainly can spend an entire webinar just talking about indirect cost allocation and statewide cost allocation plans. And so let's leave that for another day, Kurt.
Yeah. Another question, would there be situations where an entity would fit the definition of a subrecipient, but not be subject to subrecipient monitoring by the pass-through entity? No. Yeah. If they meet the definition, if the pass-through entity has deemed them a subrecipient. Now, to clarify, it's the pass-through entity's determination of, it's one of these three that are on your screen. Are they a contractor? Are they a subrecipient? Are they a beneficiary? If they have been deemed a subrecipient, they are subject to subpart F, and the pass-through entity must monitor them like a subrecipient. We'll talk later towards the end of the presentation on subrecipient monitoring requirements. There's risk-based monitoring. So if that subrecipient entity, let's say, received $1,000, maybe your monitoring is greatly reduced, but they still fall within the subrecipient monitoring requirements. Okay. Okay, before we go to American Rescue Plan, I'll just take this question just because it's very pertinent. So to confirm, for-profit entities that are subrecipients are not subject to uniform guidance. Did I hear that correctly? Yes, uniform guidance is applicable to non-federal entities that are tribes, territories, states, local governments, nonprofits, institutes of higher education. It is not applicable to for-profit entities. They're by definition not included. Now, they have a clause in there that for-profit subrecipients are subject to the terms and conditions imposed upon them by the pass-through entity. So if the state, for example, a state gives money to a for-profit business and says, we are deeming you a subrecipient and we want you to have a program-specific audit in accordance with uniform guidance, they are allowed to do that. They can impose that term and condition on the for-profit entity, but without that term and condition, that for-profit entity would be exempt. So it's the pass-through entity imposing that on them. Hopefully that kind of clears that up on that requirement. I know there's a lot of confusion there.
And certainly you're going to see a lot of that sort of confusion when we get to more deeply over the next couple of minutes on the American Rescue Plan Act, because as you notice, there's a bullet on here called economic. And a lot of governments that Kurt and I are dealing with are providing a bunch of economic development incentives, some of which are really great ideas to help the local businesses. And if money is going out to a local business, yes, you have to comply with terms and conditions, but you're not especially a subrecipient unless you're named as such.
Okay. Now, let's be honest. What's the rub? What's the hard part in this? Well, let's just say not everybody knows the right answer, and the guidance is changing, and people turn over, and there's a lot of loss of knowledge. And I've seen agreements with everything in the kitchen sink in them, with all the contractor provisions and all the subrecipient provisions. And it's kind of like, we don't know what you are, so we're going to put everything into the contract or the agreement and we'll be covered, right? And so that's where a lot of communication, a lot of patience, a lot of discussing back and forth of what the requirements are, because they're especially important. And for those for-profit entities, you know, if they have to get a program-specific audit, they need to be aware of that cost. Okay. All right. American Rescue Plan. The next big, and I skipped, half the federal legislation, but we're focusing on CRF and American Rescue Plan today. So this was March 11th of 2021, almost a year from the CARES Act. And as we all know, the pandemic continued longer than everybody was hoping for. Congress and the feds realized, hey, we need more relief than just CRF. It's not going to cut it. Here comes American Rescue Plan. And this was really kind of the add-on to CARES Act. It broadened the scope, and they gave additional relief to address economic, public health, lots to state and local governments, individuals, businesses. Now, the big one that we're going to talk about today is the Coronavirus State and Local Fiscal Recovery Fund, the CSLFRF, or the LFRF for short, just the Local Fiscal Recovery Fund. And, this is the one that billions and billions of dollars went out to the states, to the local governments, etc. The Emergency Rental Assistance Program 2 was expanded with lots of money going to more landlords and rent relief. And then, of course, many other supplemental appropriations to other programs. So we talked about the CRF FAQ number 13, and then everybody was like, well, is that going to be expanded into ARPA? Because remember, that was really specific to CRF. It wasn't really, it's not codified in uniform guidance or anything like that. What about the fiscal recovery funds? And well, we get there kind of in a similar manner, sort of. So FAQ 1.8, can a nonprofit or private organization receive funds? Now, a private organization, we can just think about that as a commercial entity. And I, again, parsed the answer out, but a recipient can provide funds to an entity, including a nonprofit organization, for the purpose of directly benefiting the entity as a result of the public health impact, negative economic impact, et cetera, as the pandemic. In this stance or instance, maybe it's instance, these entities will be considered beneficiaries, not subrecipients, and will not be expected to comply with subrecipient reporting requirements. However, beneficiary reporting requirements will apply. So kind of a similar flavor to the CRF FAQ, but acknowledging that payments being made to entities as a result of the public health impact or economic impact of the pandemic could be considered beneficiaries. Then we go on to FAQ 1313. What compliance and reporting requirements apply to subrecipients and beneficiaries? And this is where they kind of hammer it in a little bit. And they say it's addressed in the final rule, but when recipients of the fiscal recovery funds provide award funds to individuals or entities, right, as a result of the pandemic, those receiving such funding are beneficiaries of the funds. When recipients provide award funds to an entity to carry out a program in response to the public health emergency or its negative economic impact, the entities are subrecipients. So what does that mean in layman's terms? What that means is ARPA and the fiscal recovery funds are continuing this beneficiary entity concept. Beneficiaries are not subject to single audit. Subrecipients still are. Contractors still follow Part 2, and the pass-through entity makes the appropriate determination. Now, going back to this slide just a little bit, and we parse it. It says when recipients of the funds provide awards to individuals or entities as a result of experiencing public health or negative economic impacts of the pandemic, they're beneficiaries, versus when they award funds to carry out a program in response to the pandemic, those are subrecipients. What does that really mean? Well, if you're providing a subsidy as an end user, meaning, hey, my business shut down, I was harmed, and the local government is providing a subsidy to a bunch of different small businesses that were harmed, that's a subsidy, that's a beneficiary, versus a government giving money to a local nonprofit that says, hey, we need you to get out in the community and do this program to help revitalize the community. That's carrying out a federal program. That's a subrecipient. Okay.
So I guess to put it in actual real life, terms, we have a city in the Southwest that Kurt and I work with that, for example, has a not-profit assistance program, which they're going to provide one-time $5,000 direct grants with up to 40 organizations within what's called a qualified census tract within the city. And they're available on a first come, first served basis. And they have to apply during this fiscal year. And it's up to $200,000. So in that example, yes, they're signing a contract with the city, and there are some specific, things they have to comply with in terms of the contract, but by and large, probably a beneficiary, right, Kurt?
Yeah, I would agree, because they're receiving a subsidy, right? They're receiving, they were harmed in some way due to the pandemic, and they're receiving some funds to help lessen that burden. They're not being given money to go carry out a federal program. They're being given money because they were harmed during the pandemic, and giving money into qualified census tracts. They are more disproportionately impacted by the pandemic, so there's a program going to them to assist them. That would be a classic example of a beneficiary.
Now, contrast that with another government that I'm specifically dealing with. They are providing funds to a not-for-profit for homeless veteran services, but they have to house homeless veterans in accordance with federal grant provisions and also the terms and conditions of the federal awards. So that is
subrecipient, right? And hopefully everybody listening kind of understands. So in that scenario, they're giving money to the nonprofit, but the nonprofit's not the end user. The end user is the
homeless veteran.
A homeless veteran, right? So the homeless veteran is the one that's receiving the benefit. The nonprofit is carrying out the program to then pass that benefit through to the homeless veteran, but the nonprofit would be a subrecipient carrying out a program. The homeless veteran is the beneficiary. Okay.
So hopefully folks can figure out the difference here.
So there's a question in the chat. If a beneficiary does not comply with the terms and conditions of the agreement, what is the pass-through organization's obligation to recoup the funds? Well, this one is the political landmine. And here's what we're seeing across the country. Lots and lots of beneficiary programs, whether they're federal beneficiary programs, AKA PPP, right? Payroll protection program. That was a massive, and ERC, the employee retention credit, massive federal subsidy programs. And it seemed like almost every day for a while there, we were hearing about fraud in those programs. Well, jurisdictions, states, counties, etc., did a lot of small business assistance. And some states, and we'll talk about this more in the monitoring requirements, some states had a program set up that was, hey, here's how you qualify, sign on the dotted line that you qualify, and here's your money. Some had, here's how you qualify, please submit bank records. Some said, you know, and had more iterations of that. Everybody, it was kind of from a little to a lot of what the requirements were. And now that some dust has settled, everybody's like, okay, let's look at how much fraud was going on, or how many didn't comply with the terms and conditions, and what's our next step? Well, that next step is generally a conversation with whoever your, you know, deputy attorney general is, or your attorney general's office, and or the governor's office. If you're at a state level, if you're at the, you know, county level, you're obviously talking with your board, with your county manager, with your district attorney, because what's happening is it's very hard to recoup these monies. Once they're spent, it's very hard to get them back. Lots of lawsuits. It's not always easy to prove fraud. I think, you know, as auditors sometimes, and local government employees, sometimes things are very clear to us that they're improper, but that's not always clear when they're in court, right? And so there's just a difference in time and effort. And then how much are you trying to recoup? Are you trying to recoup millions, or are you trying to recoup, you know, $3,000 times 50 times? What's the cost benefit? That answer is different for everyone, different for every jurisdiction. It's definitely different. I am making no political statement, but it is definitely different depending on what party is in power in that jurisdiction. They have different outlooks on how to handle beneficiary programs and recoupment of funds.
Certainly, I think if you have a court judgment, and if your government has the ability to tax, many governments have the ability to do what's called intercept, where if somebody was to receive a tax refund or a tax rebate of any particular form, and they owed the government money as a result of a court judgment. And notice I'm saying as a result of a court judgment, because you have to have that force of law behind you. Then there's a data match that goes on. And they get a nice piece of paper saying, thank you for doing business with government of X. We have intercepted your tax refund in satisfaction of judgment Y. And so if you have that ability within your systems, and it's actually pretty easy to set up in most systems. I mean, I know of one government that's been doing it for 25 years, if not more. It's pretty easy to set up. That's a way to recoup. But again, you have to go through the legal process.
Right. And there's obviously a cost benefit of that. There's a political cost benefit and a dollar amount cost benefit. And well, tomorrow is a pretty important day. And so let's just say it's been a wide range of handling recoupment of beneficiary dollars across the country. Okay, so moving on to some other examples that maybe we've talked about some of them. If you guys have examples or have what ifs, please feel free to chat them. But here is a fact and circumstance. So County A is running a business interruption program for all nonprofits to apply. If a nonprofit can evidence fundraising loss, the county will reimburse the nonprofit for the fundraising loss, not to exceed $50,000. So they put a cap on it. So the county provides the fiscal recovery funding to a nonprofit which qualified by showing the decreased fundraising dollars. There are no other terms and conditions imposed other than spending the money on organizational costs. Okay, this is the classic example. You can't get more classic than this one, at least at an entity level, of a beneficiary. So why? Let's just parse it down. Is the nonprofit receiving money as a result of the pandemic? Okay, yes. Is it receiving it as a subsidy because it had public health or negative economic impacts? Or are they carrying out a program to address public health or negative economic impacts? Well, the nonprofit itself was not able to fundraise during the pandemic, right? Very common, not able to fundraise. So the nonprofit itself suffered harm, negative economic impacts as a result of the pandemic. The money is going to them. They don't have to go do other things with it. There's no other terms and conditions. They don't got to go benefit some populace. It's here's some money. That is a beneficiary in basically the most classic example. County A is running a business interruption program for all small businesses to apply. Okay, so we just got rid of the nonprofit. We say it's a small business. If a business can evidence loss of net income via comparative financial statements or tax returns, the county will reimburse the business. However, the county quickly realizes that, hey, we don't have the manpower, the resources to do all of this. That's a lot of administrative tasks. So to kind of facilitate this, the county decides to provide $5 million to a local nonprofit to run the program. And the local nonprofit will make the payments to the small businesses. Okay, so here's another very classic example, very classic, where the nonprofit is running a program for the county. They're getting $5 million. Now, presumably out of that budget, some of it's reimbursement for payroll and the costs incurred by the nonprofit, and the rest is the subsidy pie going to the small businesses, and the businesses are beneficiaries. Now, Eric, looking at this type of program, do you see any arguments to make the local nonprofit a vendor in this type of situation? Because I know I got this question a lot, and I've been consulting with a lot of different entities on whether they can determine the nonprofit to be a vendor. What do you think?
I think it's really borderline. So, for example, if that was the vast majority, if that $5 million was the vast majority, if not the entirety of the nonprofit's business, then, or I wouldn't say business is probably a bad word, the nonprofit's operations, I would probably conclude that that is a subrecipient. And especially with the control aspect that's built into the agreement, that they're supposed to vet the businesses, review the tax returns, and potentially if there's issues, be held accountable for it. If that's the case, I don't see them as being a vendor. I see them as being a subrecipient. But I would also want to make sure that the county's contract with that not-for-profit is pretty ironclad in spelling out what their duties and responsibilities are. And certainly if the not-for-profit does not have the wherewithal to carry out those duties and responsibilities, I think we might have a problem there. And in fact, there would be a vendor. Now, for example, again, same city I mentioned before, they have a gift voucher program for small business in the city, where essentially, it's to get people to go shopping in the area, and the area is again part of qualified census tracts, and the gift cards are for only $25. And I said to the city, do you really have the systems to track all those gift cards? And by the way, there's a boatload of gift card fraud built into the economy as it is anyway, where people trade gift cards and so on. Do you have all those systems? And they said, well, no, we don't really think so, especially given the fact we want to limit the program and we want to limit the trading and so on. And I go, well, why don't we engage a nonprofit that may have those resources and provide that? And I said, no, you're not going to engage Eide Bailly to do that. You got to engage, say a not-for-profit to do that and have them held accountable for those terms and conditions. And by the way, that program is about half the size of this particular program that's being contemplated. So again, it comes down, in my mind, to facts and circumstances and what's in that contract. Don't you agree, Kurt?
I completely agree. And this next example here is kind of where we would take that and, well, let's just spin it. Let's just change it a little bit. Okay, so assume it's still the same business interruption program. Same qualifications, comparative financials. And to facilitate this process, the county is paying a local nonprofit to collect and process applications and then send the results back to the county. The county then obviously reviews the applications and the results. And if they agree, then they're paying out the small businesses who qualify. So kind of the, difference in the scope of work between this one and the previous one, other than the county's paying the small businesses versus the nonprofit, is the county is looking at this as we're paying the nonprofit for a service to process applications, but then send that back to us, the county, to then review it, process it, and pay. That's paying a service rather than asking the nonprofit to carry out the program. And Eric, I think this speaks to your point on the control environment, the scope of work. How is that? I'll call it an agreement, a written agreement. How is that really detailed? One part that's not necessarily in here and that's kind of vague in the guidance is what's the overall intent? And sometimes the intent isn't, black and white in the agreement. Sometimes you've got to be familiar with the program and say, hey, the intent here is really for the nonprofit to just collect information for us and give it back to us so that we can pay and run this program, versus no, the intent is really to give money to the nonprofit and let the nonprofit run with it. Those are two different concepts, and that's important to document so that you can determine whether that nonprofit is a contractor or a subrecipient. I know we aren't bringing in the beneficiary piece here, but again, the beneficiaries in this example are the small businesses.
So as an example, here's an example. For example, we have a utility bill assistance program where there's a $25 bi-monthly credit that is applied to somebody's utility bill if they pass all these qualifications, that maybe they're part of transitional aid for needy families or part of Section 8 or some other provision. And there was a list in the program overview that I was reading earlier today that listed about 8 or 9 criteria. And to do that adjudication, you hire a local not-for-profit to figure out whether or not those folks meet that criteria. And if the answer is yes, then report back to the city utility saying, person ABC with this utility bill number is eligible because they meet this criteria under A, B, C, D, E. And they have to re-enroll every 6 months to be provided this $25 gift card, not gift card, but utility bill assistance program, of which the $25 goes right off the bill. And that way, no cash is really exchanged. Now, that is perfectly acceptable for ARPA under the negative economic impact. It fits within, a couple of frequently asked questions. It is a reporting line within the reporting mechanism of ARPA. But again, notice that I said there's a nonprofit making those adjudications.
Right. And so in that scenario, you can say, okay, the nonprofit is a contractor because we're asking them to provide a service. However, if you just turn that a little bit, and let's say the city utility said, hey, nonprofit, we're going to give you all this money to run the program and remit the monies to those who qualify. And instead of putting a $25 credit, the nonprofit's going to send $25 checks out to the households that qualify.
Right. Totally different.
Okay. So is everybody hopefully kind of understanding the differences there? And in both cases, the beneficiary, the end user, is still that household, that homeowner or the household, the landlord, whoever's responsible there is the beneficiary. The nonprofit's not the beneficiary. The utility company obviously isn't the beneficiary. The beneficiary is the end user receiving the benefit.
Yep.
Okay. There's a question in the chat. What about the guidance in 200.331 subrecipient and contract determinations? Well, that's coming up in just a couple of slides, and we will go through the differences in the guidance there. So
he probably had coffee a lot sooner than we did. You know,
just excited for it.
Yeah.
Okay, another example. State gives money to a local housing authority. The local housing authority runs an assistance program for individuals. Wow, this sounds familiar. In a census tract in response to the negative economic impacts. Okay, we've been over this a couple times. So in this case, the local housing authority is running a program. Okay, they're carrying out the program in response, in this case, to negative economic impact. So they are a subrecipient, and the individuals are the beneficiaries. Okay, this is another very classic example.
The place where you need to really be careful with housing authorities is, especially on the state level, is when you're talking about mortgage finance, loans that are backed by ARPA money, or loans that are there for low-income housing tax credits. That gets a little bit squishy. And so if you have that sort of stuff going on, and I know there's a bunch of state folks on the call, on the webinar today, looking at the list, and certainly counties may have this situation as well with county housing authorities. Just be aware that you have to be careful. There's just a fine line between what's a subrecipient and a contractor, especially in dealing with those low-income housing tax credit entities.
Yep. And, again, now we've got to think, what's that third determination? The beneficiary. Beneficiary is the homeowner. Housing authorities aren't really ever going to be a beneficiary because I'm assuming the money is not going to the housing authority to make them whole for some reason as some sort of subsidy. It's also pretty rare for governments in general to be beneficiaries because if you think about it, there are lost revenue calculations, right, under ARPA. And some states I've seen have also allocated additional funding to local governments based on some sort of revenue calculation. But I would say in general, it'd be pretty hard to convince me that any government or local government is a beneficiary. I would say in almost every case, they would be a subrecipient. Maybe in very specific cases, they could be a contractor. I'll give you one example of that I saw that I thought, that's reasonable, where the state did not have their, the state medical lab was at capacity and they couldn't process COVID-19 testing. They had way too much backlog. And so they contacted a county and say, hey, we need to use your medical lab for COVID-19 testing. And we'll pay you, you know, an X rate per day that we have to use your facilities for COVID-19 testing. In that instance, the state is pretty much purchasing, you know, medical lab facilities from the county. I would call the county a contractor in that very specific instance, because the county's not really carrying out a federal program in that case. The state is really just purchasing the ability to use the medical lab. So in very specific cases, a government could be a contractor, but I would say, I don't know, 99 times out of 100, probably a subrecipient. I don't know, Eric, if you can think of any other scenarios that I might be missing.
I mean, sometimes in emergency management, you might see stuff like that where, you know, the state facility or the county facility is out of commission for, you know, because of some disaster. And then you get, you know, the local facility is being pressed into service and there's a payment that goes there. But again, it's more the exception than the rule.
Yeah, I guess that brings up a good point. You know, payroll, like maybe if you had to utilize their public health personnel for whatever reason, you know, whether you needed some extra firefighters or police officers or some sort of public health or public safety personnel, and you needed to contract with them to help cover, you know, somehow help cover your own jurisdiction. That could be some sort of, you know, interagency cooperative agreement type thing where you're operating more as a contractor relationship. But again, I would say in most cases, governments would be subrecipients. I did have one that was, they gave money to a like the local tourism authority to run ads and marketing. That one I could also see as a service, right? Because you're paying for marketing materials and ad space and that type of stuff. You know, again, there is a little bit of wiggle room there, but I would say governments in general would be subrecipients.
Yep.
Okay, let's see. Yeah, there's the medical facility one. I already talked about it, so we'll go through there. So again, if you guys have other examples, we didn't cover something, or you're stuck in the gray area, please chat them and we can talk about it. Okay, we've talked about this a lot already, but this is again a reminder. The pass-through entity sets the terms and conditions for the other entities, whether they're a for-profit, a nonprofit, you know, another government. The pass-through entity makes the determination of whether they're subrecipient, contractor, or beneficiary. Unfortunately for the entity, they can be and wear a lot of different hats, meaning they can be, I'll throw an example. Let's say it's a nonprofit. The nonprofit can be receiving fiscal recovery funds as a contractor because the county's paying them to process applications. They can be receiving the funds as a beneficiary because they had fundraising loss and the state has a program for that, and they're getting money under fundraising loss. And they could be receiving monies as a subrecipient because the city's giving them money to carry out a homeless veterans program. And so that scenario, that poor nonprofit and those poor auditors are trying to piecemeal and parse all the different funding that all came from ARPA. And they're like, okay, from the county, you're a vendor.
'and a contractor.
And a contractor. So this is not subject to single audit. And from the state, you're a beneficiary. So this is just contribution revenue, and you're subject to whatever terms and conditions the state imposed on you as a beneficiary. And then from the city, here you're a subrecipient. This has to go on the schedule of expenditures of federal awards because you are subject to single audit for these monies. That is obviously a very convoluted example, but it goes to illustrate that entities can wear a lot of different hats and with the same funding source. There is, and I didn't include it here, an FAQ on how do entities treat multiple awards, like if they're a subrecipient from the state and a subrecipient from the county and a subrecipient from the city, all under ARPA. Well, you include all of it, right, on your schedule of expenditures of federal awards. It's all one program, major program for testing purposes anyway. If you're a nonprofit, you're not worried about the lost revenue calculation. If you're a government, though, and you're trying to figure out your lost revenue election and all of that, then you do get to combine the funding to figure out how much can my lost revenue go. You don't have to like do 3 separate calculations on lost revenue. You can compile that in to your maximum subawarded amounts. And I know we didn't include that in there. I was just adding that as a sidebar. And again, that last bullet point, this is the almost for verbatim from the for-profit monitoring requirements in uniform guidance. But again, the agreement with the for-profit subrecipient must describe applicable compliance requirements, and the methods to ensure the compliance requirements can be made, can include pre-award audits, monitoring during the agreement, and post-award audits. And that means something different to everyone. A question in the chat, can I comment on how this would be CFA reported? Yes. So what goes on the schedule of expenditures of federal awards is the amount that you receive or that an entity receives as 2 things: a direct recipient from the feds or a subrecipient from a pass-through entity. Those are, at least under fiscal recovery funds, that's what would be reported on the CFA. Monies you receive as a contractor do not go on the CFA unless it's a cost reimbursement contract under FAR. We're not going to go into that today, but in general, direct recipient from feds, pass-through dollars that you receive, as a subrecipient, that's what gets included. A lot of local governments on the call received some sort of federal NEU allocation or a county distribution or a city distribution. If you also receive money outside of those standard distributions from a state or from a county or city, those also go on the CFA. If you're a beneficiary, they do not. But like we said earlier, governments probably aren't going to be a beneficiary in almost every case. I can't really think of a beneficiary example for a government.
And again, the way to illustrate this is, let's say a county provides a city, and specifically within the city, a sewage district, money for, what does it say here, an interceptor to inspect and clean the water line. And because there's pipe that's leaking and so on. So that's perfectly acceptable under ARPA because it's infrastructure. But that sewer district may also be getting state revolving fund monies, may also be getting direct federal monies if it's really in a bad situation where, say, it's polluting the local river and so on, where they're receiving direct EPA money. So all that needs to be reported in the CFA, but in 2 separate columns, effectively, under where it says sewage district, and I'm trying to mask the name of the government, sewage district, grant award number, and other pertinent information that's required by the CFA.
Yeah, and then as far as CFA for for-profits don't have CFAs. They will, if they're required to have a program audit, then they will have a schedule of expenditures with relation to that program. And then they're recorded exactly, whatever their expenditures were during the scope of the audit period, whatever year end it is.
But you really only see those in maybe DOD, maybe transportation, maybe housing, but that's about it, at least in my experience. I haven't really seen too many program audits at all.
Yeah, we're seeing it a lot now in health and human services. So
yeah.
Provider relief funds are probably beyond the scope of this presentation for the most part. But provider relief funds, for those of you that don't know, a lot of money went to healthcare, obviously. And if you build Medicare, you could qualify for these provider relief funds. And healthcare, obviously, there's governmental healthcare, nonprofit healthcare, commercial healthcare. And they didn't really scope out the types of entities. It was, if you bill Medicare, you qualify. But they still wanted to look at all these commercial healthcare entities. And so they scoped them into audit. We won't get into the PRF audits and what that's been like the last few months. But in kind of doing this, HHS kind of started opening the door for for-profit program audits of their programs. And I've had a couple in HHS that have never required to be audited before. And suddenly this provision is coming down of, hey, you're a for-profit entity, you receive $750,000, and we want you to have a program audit. So seeing it a lot more. I actually expect it to increase going forward. I think this is going to be a more common occurrence as we go forward. Yeah. Unless things change significantly in Washington. That could, all of that.
Anything can happen. Yeah.
Anything can happen, right? Okay. We had the question earlier. What about the guidance within 200.331 subrecipient and contractor determinations? Well, here it is put into table format. Okay. Now there's a third column missing. What's the third column? Beneficiaries. But hopefully we've talked about beneficiaries enough, recognizing that they're the end user, the subsidy recipient, that everybody's able to understand the difference between a beneficiary and a subrecipient. But as far as the contractor versus subrecipient side goes, on the left, you have the subrecipient creating an assistance relationship, determining eligibility. Now, we had some examples earlier where that local nonprofit may be processing applications, but maybe they're not making the final determination. Maybe that application goes back to the county or whomever to, review the determinations and sign on the dotted line at the end of the day. The subrecipient generally has performance measured in objectives of the grant. They have some programmatic autonomy, right? Some decision-making on how to carry out a program, how to best use the money. Their terms and conditions generally say, hey, you're a subrecipient, you have to be audited under uniform guidance. You have to follow all these regulations and terms and conditions of the grant. It's generally carrying out a public good, right? You're getting money to carry out a public good. That is generally the subrecipient. Contractor side of the house, they're providing services in a competitive environment, right? Some sort of procurement relationship, goods or services. It's generally their normal business activity. They provide similar goods to a lot of different providers or purchasers, right? So, your widgets that you're getting from them, they can provide those widgets to 100 different purchasers, not just you. Okay. They provide goods, services as ancillary to the federal program. Basically, you're ordering or purchasing something from them. You're not asking them to carry out some sort of public good or public assistance. Okay. Now, is it super easy in practice? No, because a lot of these agreements are gray and they have elements of both. So what do we do when there's elements of both? Well, everybody's favorite catch-all is judgment. You have to use your judgment. I get this question from my staff all the time. I'm new here. I don't trust my judgment. It's like, okay, well, when you recognize something that's unusual, why don't you bring it to my attention and we'll walk through it together and talk about it. I don't ask you to, have the best judgment. I just ask you to have the judgment required when it's unusual to tell me about it. Similar in your cases, if it's unusual and you're on the fence, I highly recommend reaching out to your auditor or your local Eide Bailly professional or another person in the department and running the scenario by them. There's nothing wrong with asking for a second opinion. Like, hey, we've got this relationship. Here's the characteristics. Here's what we think. Is that reasonable? What do you think? And just talking about it. Nothing wrong with that.
And certainly, I think this is where, I brought up at the beginning, a lot of governments and entities are using checklists. And those checklists need to be signed off on and then reviewed by somebody and dated and so on. And as long as as long as you're being consistent with how you make those judgments, I think you're okay, unless you're consistently wrong or in making those judgments. I think you're going to be okay. And you document your decision and so on. Again, a lot of states have them. There's a great one, not to be a shill for an organization that Kurt and I are part of, but AGA has a great subrecipient checklist that's freely available on its website. Go to agacgfm.org and download it. And so certainly make those determinations, document your decisions, and then have them available for audit.
Yeah, and I would say I've seen a lot of borderline gray agreements before, a lot that you read the scope of work and you go back and forth. I would say in almost every single time in one of those gray area agreements, as long as the entity documented their position, I've been fine with it. It's when they don't document anything and it's completely gray and they have no basis for their original conclusion. That's when the can of worms gets opened, because it's like, well, if you don't have a basis for your conclusion, now we're gonna dive into this and go into it. And that's when questions occur versus what's your basis? And you give me this documentation. I go, okay, well, that sounds reasonable to me. Let's move on. You made a judgment call and it's at least reasonable and we'll move on. So it's very important to document it. What do we mean by substance of the agreement? What that means is it does not matter what the name of the agreement is. Whether it says contract at the top or cooperative agreement at the top or purchase requisition at the top or purchase order at the top or whatever the name of the legal instrument, that actually does not matter. The feds codified that a long time ago. That said the name of the agreement does not matter. We don't even look at the name. We look at the scope of the work, the substance of the transaction. If it's titled contract at the top, but it is a subrecipient relationship, they are a subrecipient regardless of the document being called contract. Okay, and I know that can be confusing. What happens in those scenarios are generally the boilerplate language for the contract is written with Appendix 2 provisions, not subaward provisions. And then they have a bunch of findings on not communicating certain stuff, but the substance is the most important. Question in the chat. For our ARPA funds, we have passed through some to nonprofits that carry out programs that are normal in their ordinary course of business, but would fit some of the definitions and the uniform rules of ARPA, basically covering payroll and training supplies for these programs. We have considered them subrecipients. Would there be any instances where they'd be beneficiaries? So I would say at face value, you're probably correct in that they're subrecipients, because you're giving them money to carry out some sort of public assistance program, right? They're carrying out a program, it's public assistance, you're reimbursing them for their payroll to carry out the program, but that's very normal. Where would they be a beneficiary? If you said, hey, due to the pandemic, you didn't want to lay anybody off, you had to retain payroll, but you couldn't raise money. And so let us know if you maintained your payroll and what your loss in income was during this 6-month time period. And we will just give you a dollar amount equal to what that lost income was. Then you're giving them a subsidy, right, to kind of make them whole as a result of the pandemic, versus saying, hey, we want you to carry out a program that responds to the pandemic. That's different. Hopefully that kind of makes sense.
Yep, I think so.
Okay, let's pretend now that you have determined them to be a subrecipient. And what are the monitoring requirements of subrecipients? Well, to break it down into kind of 3 buckets that I at least do in my brain to kind of help have it make sense, is there's pre-award requirements, there's ongoing requirements or during the award requirements, and then there's post-award requirements, or at least after each fiscal year requirements. So pre-award requirements, those are all the required data elements on subaward communication. So this is where, unfortunately, due to the pandemic and the chaos that ensued, where we're seeing a lot of problems. What's required in the subaward communication? Well, it's stuff like, what assistance listing number is it? What federal agency is it? What's the period of performance? What are your eligible costs? What are special terms and conditions? What are your reporting requirements? That it's subject to audit, that they've got to have open access to records, okay? What's the unique entity identifier number? It used to be the DUNS number. You know, what are some of these different things? Who's the contact? All of these things needed to be in the subaward. Why? It's because to tell the subrecipient that these dollars are subject to audit, subject to uniform guidance, needs to go on their CFA, and here's all the identifying information for their CFA. Now, unfortunately, with the pandemic and how fast money was coming out, a lot of these agreements didn't take place. In fact, in a lot of jurisdictions, I saw emails that said XYZ amount of money is going to show up into your bank account. The terms and conditions are posted on this website. We are going to assume that if you do not return the money to us, that you have an implied acceptance of the terms and conditions posted on this website. Please contact us with questions. Thank you. And that's it. There's no signature on the dotted line. There's no signed agreement. There's no anything. Unfortunately, that has caused a lot of confusion and kind of has led to where we're at today. But theoretically now things have come down somewhat. You should be entering into proper agreements. Your beneficiary agreements, if you determine them to be a beneficiary, should not have all of these uniform guidance requirements in them. They should have terms and conditions that you're imposing on them as a beneficiary. What are you requiring them to do to qualify for the program? Do you require them to spend the money on anything? What type of reporting requirements do you have? Are you requiring them to have some sort of AUP engagement or audit engagement or monitoring engagement? All of that needs to be in the terms and conditions, but that is up to you, the creator of the program, to decide. Then you have during the award requirements. So what's required during the award? As you're in the middle of the period of performance, you have to monitor at a bare minimum their financial and performance reports. At a bare minimum, you're monitoring those. You can do things like site visits. You can do desk reviews. You can obviously ask for supplemental documentation for eligibility determinations or procurement transactions. If you notice anything that needs correction, you can issue findings. You're required to issue findings. If you formalize that, you need to issue management decisions on any findings that you become aware of, right? And they can have other audits, other monitoring engagements, or your own that you're issuing management decisions on, and you have to monitor their corrective action. Post-award, or at least subsequent to the fiscal year requirements, the findings, management decision, and corrective action items are the same. You're still monitoring for those, but you also have to make sure they obtain their required single audit. Is this missed a lot? Yes. Why? I don't know. The subrecipients may or may not know they are required to have a single audit. If they haven't gotten a lot of federal funding before, they may not even know what a single audit is, especially if there was no agreement and they had an implied acceptance of terms and conditions, then they really might not know they were required to have a single audit. It is the pass-through's responsibility to ensure they obtain their single audit, or we're not required to have one. And how do they do that? Well, you can get an affirmation from the subrecipient saying that their total federal expenditures were under $750,000. You can ask for their financial statements to look yourself. You can compare that to aggregate awards that at least your agency has given. There's a couple of different mechanisms you can do, but you do need to have some sort of control mechanism to ensure they either obtained one or weren't required to have one. It's due 9 months after their fiscal year. There are no more extensions on single audits. So you should be monitoring that.
Certainly in my experience being formerly with the state, I used to have to do this, and I was doing this before the uniform guidance, and it was always the bane of my job until I factored it out to a state department to go do it for me. And even they didn't do it all that well, but I got findings every year, and it was not fun until I figured out how to change it. And even then it evolved during uniform guidance. But it is, if you're the person who has to monitor, we feel your pain, especially with ARPA funds. And that's why we do a lot of work in ARPA, subrecipient monitoring between Kurt and myself.
Yeah. Okay, so to be a little bit more specific on the during the award requirements, again, must include review of financial and performance reports. Now, financial reports can be reimbursement requests. That is a form of a financial report. If that's what their financial report is saying, hey, for quarter one, we spent $275,000, please pay us. Okay, well, you have to review that. Hopefully it's more than just an invoice. They should have some cost. Now, the amount of backup you get, we'll talk about on the next slide. But you do have to review financial and performance reports. Again, you have to follow up with corrective action. You have to issue management decisions, on-site reviews, desk reviews, independent audits, rotated as necessary. Your overall subrecipient monitoring package, your policies and procedures, they need to be designed to obtain reasonable assurance that the subrecipient materially complied with the terms and conditions of the program. Now, when we talk about reasonable assurance, that does not mean absolute assurance. So what that allows for, and what the feds actually require, is a risk-based monitoring approach. Okay, risk-based. How do we make it risk-based? Well, we perform, or you perform, the pass-through entity performs a risk assessment. Okay, there's a lot of different factors you can include, whether it's prior experience administering awards, results of previous audits, how new are their personnel or systems, have the feds alerted you to anything? There's a huge list of factors that you can consider. You can build your own. The world is your playground, and you can perform risk assessment. Then generally what we see, low, moderate, or high is the risks conclusions that we see. For low risk subrecipients, maybe you only look at a sample of charges or a smaller sample of charges. For moderate subrecipients, maybe you look at a little bit more. And for high risk subrecipients, maybe you look at everything because you can't trust them to get anything right. Regardless.
Certainly in this one, I like to spend a lot of time in risk assessment because you either do it before the disbursements or you're going to be paying for it later. And so do not underestimate this. And certainly, again, be consistent about your determinations of high, medium, or low. And don't try to gauge the system just because, hey, you want to make something happen a little bit faster.
Right. So as Eric just said, you would normally do this risk assessment process at the beginning of the award term. And then what you deem them, low, moderate, or high, dictates how much monitoring. Now, you still need to perform monitoring on the low subrecipients, but you have to perform, you start low and you can perform more as you go. I get this question all the time. If they're new, do they start at low and go to high if they're bad, or do they start at high and go to low if they're good? If they are new to grants or new to the program, generally I would say they need to prove it first. So I would say the default is high, and then they earn getting to moderate or low. They do not default to low, and then, if they get a slap on the wrist, they go to high. They usually start at high and then earn going to low. Why is that? Well, you will find a lot of errors in people new to grants. That it's not that they're intentionally doing things wrong, but you will find a lot of errors, and there's a lot that they got to get caught up to speed on before they can get to pretty much a low subrecipient.
Bottom line, it's your name on the grant award to the federal agency. And so if we mess up on subrecipient monitoring, guess who gets the first email or call? That would be you. It's not Kurt Schlicker. It's not Eric Berman. Right. And so think about it that way. And so if you have a new entity, start it high and then go down low.
So one tool that I just wanted to include here at the end, because I get a lot of these calls too. We are at capacity. We have no FTEs. The legislature won't approve any more budget positions, whatever. What can we do? We can't monitor, and especially under ARPA, where we've got hundreds and hundreds of subrecipients, we can't monitor everybody. Well, if you need somebody to fill the gap, you can arrange for what's called agreed upon procedure engagements. You essentially, the pass-through entity contracts or engages with an independent CPA firm to review compliance. It's generally limited in the scope to like allowable costs or eligibility or reporting, something specific. But you essentially engage a CPA firm to go look at a sample of allowable costs or a sample of performance reports or both, beneficiary applications, whatever, and ask them to do that. They perform that engagement. They give you a report at the end. They say, here's what we found. Here's our findings. If there are findings, then you issue management decisions and help the subrecipient take corrective action on those findings. But you can use that as a form of subrecipient monitoring. Why is this beneficial? Well, obviously you can do your own cost benefit analysis to where if you're just short resources, but you need to get some monitoring in, then this is the option you can use. Now, honestly, it's not going to be cheaper than running it in-house, like your internal payroll, to have somebody monitor it versus hiring in professional services a CPA to go do it. There's a different dollar per hour there, but we all know sometimes FTEs is a different concept than professional services and contracting. So again, sometimes if you need help, the AUP engagement is available. Okay, we got one question that I see we haven't covered yet. Can I cover FFATA reporting requirements for subrecipient awards? Okay, I'll cover it relatively quickly. The FFATA reporting requirements are required on the first tier recipient, meaning whoever's receiving the monies direct from the feds. If you are receiving monies direct from the feds and you enter into subrecipient relationships, awards over $30,000 are required to be reported in the FSRS, which is the FFATA subaward reporting system. So again, there's qualifications there. If you are a direct recipient from the feds and issue subawards 30,000 or more, including amendments that aggregate, you are required to report that. If you are receiving the money as a subrecipient, so you're a county and you received it from the state and then you issue subawards, you have no FFATA requirements. The requirement is on the direct recipient first, and then it doesn't pass through down to the lower tier entities. That is the FFATA requirement. Now, with some of the pandemic COVID-19 funding, especially a couple of the Treasury programs, like local fiscal recovery funds, ERA, I think was another one, Treasury agreed to do the FFATA reporting on behalf of all the recipients because the reporting mechanisms they had in place was already reporting subrecipient relationship back to them. And Treasury has guidance out there that says, hey, you don't need to take care of the FFATA reporting. We are doing it for you on behalf of all the recipients. It's because they're already collecting the data through their other reporting mechanisms.
Now, be careful.
Oh, you just muted yourself, Eric.
Yeah, now be careful. There is a bill pending in Congress that is attached to the U.S. Department of Defense's Reauthorization Act that is bipartisan, that may require standardized financial reporting for state and local governments by 2027. Will it look like FFATA reporting? I hope not. Will it look like what's reported for the SEC? I'm not sure, but stay tuned. It is, there's a lot of chatter about this particular bill that is being put forth by Senator Warner of Virginia and Senator Lee of Utah, and a similar bill in the House. And so you could see kind of interesting reporting changes. Maybe we'll talk about that during the GASB presentation coming up in December. Let's see, what else is here? Aggregate reporting for beneficiaries, and how does that work? What do you think, Kurt?
Yeah, so if you look at the reporting guidance, right, there's all those payments under $50,000 to individuals. That all just gets aggregated and scoped into there. Now, if you're running programs and like assistance programs and giving subsidies to entities and all of that, then you're looking at the reporting requirements and assuming they're over $50,000, you're looking at the reporting requirements under responding to the public health and economic impacts requirements. Just the reporting requirements have changed a lot, and they keep morphing and they keep getting tweaked. So there's guidance that comes out on that all the time. I would say currently refer to the compliance and reporting guidance that is on Treasury's website. It's like a 56-page document. Is there vagary in it that leaves some things to be desired? Yes, especially if we talk about evidence-based outcomes and what is an evidence-based outcome. I still don't know the answer to that. We all kind of just make our best guess. They kind of have an example of what's a evidence-based outcome and like a quasi-evidence-based outcome, and the differences between the two, and you just read it and you're like that. Oh, okay. I would say, though, try to follow the guidance as best you can. It is ever changing. Aggregate less than 50,000 is very similar to CRF and gets aggregated.
We could easily spend another one CPE, maybe two CPEs, just going through the reporting mechanisms, the ones that are due quarterly, for larger governments, and the ones that are due annually for all governments, or all recipients, I should say. And again, it is changing frequently. The guidance is freely available on the U.S. Treasury's website. Just try to follow it as best as possible, and certainly reach out to us if you have questions. I don't see any other questions in the chat, Amy or Kurt. Certainly from my standpoint, I want to thank everybody for joining today and taking precious time out of your day to join us, and certainly our friends and colleagues at Eide Bailly and clients and non-clients. We really appreciate you and hope you have a great holiday season. Kurt.
Yeah, no, I echo everything Eric just said. If you have questions that we didn't cover, you have some sort of complicated scenario that you weren't able to talk about, or it was too long to talk about in the chat, feel free to email Eric or myself or both of us. Happy to get on a call. I'm happy to walk through a scenario and talk about it. There's our contact information. And again, thank you everyone for attending.